Awesome. Thanks, Derek. Like Derek said, my name's Pete Wautlet from Bakertilly. We work in our Janesville office. I've got 3 of my cohorts with me today. It's Brad McGuire, Kyle Mayer, and John Lowe. John works out of our Madison and Janesville office, and I'll let those guys introduce themselves a little later as they do their part of the speaking. So we're certainly glad to be here today. We're going to talk about tax strategies for 2019 and beyond. I think last year we were here in May talking about the tax reform that happened in December of 17. I was talking to Jim File earlier, I don't know where he is. We thought maybe next year we'd go out on a course and we'd pick 18 topics and have everybody linked up to so, I don't know, we'll think about that. That's a good idea. I like that. So, before we get started, I did want to tell you a little bit about Bakertilly. So, you can see some statistics up there. We're a pretty large firm at this point. Back when I started 30 years ago, we had about 200 people in the firm. It was a small regional firm that started out in Wisconsin. We had offices in Elkhorn and Janesville and in Watertown and the like. So certainly our roots are in this area, and we certainly like to stay connected to this area. But we've grown quite a bit organically and through mergers. We go as far east as DC and New York, and as far west as some recent mergers in Texas. We have an office in Dallas and Houston. So with that brings a lot of resources to the firm that we can tap into. The firm specializes along industry lines, so things like people who focus on manufacturing or construction real estate or not-for-profits or governmental. So we try to get people focused in a certain area so we can better serve our clients. We've also got a lot of services that, specific services we provide, valuation service, trust and estate, which John will talk about a bit. And so again, we try to bring a local touch to the clients we deal with, but also can tap into resources across the firm to bring specialized solutions. So the topics we're going to talk about today were the ones that we discussed a lot last year with our clients that we built tax strategies around, and the questions they asked us that were important to them. So, because there's a lot of new tax law with the tax reform, and certainly last year was the first year that we implemented it. Hopefully you guys with your tax professionals worked on some tax planning strategies last year for the first year of tax reform, but we're going to talk about what we can do going forward. So with that, we'll get started. Like I said, I'm going to have Brad McGuire talk about, business tax matters. And then I'm going to have Kyle Mayer talk about individual tax matters. I've also asked Kyle to talk about one of our service lines, which is called BT Advantage. And it's centered around trying to make sure our clients have up-to-date real-time financial data in order to make better decisions and implement tax planning strategies. And then I'm going to have John Lowe talk about estate and trust type things, succession planning, which is important, not income tax, but overall tax planning for life. In between there, I will talk about some Wisconsin tax matters as well. So that's going to be the program today. We'll start it with Brad. Thank you.
I am the perfect example of what happens when old fat guys still try to play basketball. So we're recovering from an injury about 1.5 years ago, and it's flared up again. So we have the clicker. Yep. So the Tax Cut and Jobs Act that was passed in 2017 had a lot of provisions, and one of the most interesting ones, and actually taxpayer friendly, is the qualified business income deduction. It's under Code Section 199A, which is a new section, and part of the code dropped the corporate tax rate dramatically from 35% to 21%. And a lot of businesses, especially small town local businesses that we deal with, are not structured as C corporations. And so Congress looked at that and said, we need to provide a cut for other businesses that operate as partnerships and as corporations and flow through type entities. So they put in the qualified business income deduction. And they said, this is kind of going to equalize the flat rate. The C corporations a flat rate, individuals have a progressive rate. So we're going to make this a 20% deduction, and the top individual rate's 37%, so it kind of drops down the top rate on business income to 29%. So it's a quasi-equalizer that they put into the code so that everybody didn't just go out and rush and change from an S Corp to a C Corp or from a partnership to a C Corp. So it kind of left some of the benefit from being a flow-through. So this was it's a nice deduction. It's taxpayer friendly. It does provide a nice drop in taxes from the year before on a lot of our small businesses. So I need about 3 hands here. So just some of the provisions. It began for businesses with income after December 31, 2017. It does sunset under the current code. And the only thing that's permanent in the tax code is nothing, because Congress can change anything anytime they want. Some things are in with a specified expiration date, and so they have to be renewed, so they're less permanent. So this is a less permanent provision in the code, because it does actually sunset on January 1, 2026. And how's it computed? Basically, it's just a flat 20% deduction for qualified business income. And so what is that? And the first thing to determine is the qualified business income, there has to be a trade or business. And that seems very elementary, that you have to have a trade or business, but there is some question marks out there, especially as you rent real estate. Is it a trade or business? Or some other things that people are only marginally involved in. And is it an investment or is it a business? And so that's the first determination that you have to have. Is it a trade or business? 20% of the income generated, again, reduces the top rate from 37 to about 29.6. The income must be generated domestically from a trade or business, and we talked about that. And there are other provisions in the tax code that talk about passive versus active. 199A doesn't care whether you're passive or active as long as you have the trade or business. So you can be a passive investor in a trade or business and you're eligible to get this deduction. If you have a loss in that business, you might not be able to take the loss because it's passive, but if you have income, you get this qualified business income deduction. So the code treats the same income in different ways in different places of the code. QBI is evaluated on the trade or business and cannot be used to offset self-employment income. So if you're a Schedule C sole practitioner, this deduction only offsets income tax and not your FICA and your Medicare. And again, it sunsets on 2025. So that's one of the things that we've looked at. And we want to do some planning, but we don't want to make drastic changes because it's not permanent. It's not written into the code. It's kind of at the whim of the next Congress as to whether or not it will get renewed. So who qualifies for this? Individuals and trusts. This is not eligible for C corporations. They've already got their benefit with the lower tax rate. So sole practitioners, Schedule Cs, rental income that's characterizes trade or business. We'll talk about that a little bit in a bit as to whether or not just rental income can. Rental income by definition is passive, but it can be a trade or business for Section 199. So again, the code treating the same type of activity 2 different ways in different sections. Partnerships and S corporations flow the deduction through to their individual shareholders. The C corporations that get the flow through it doesn't do them any good. And another thing that was clarified in 199A is that almost everywhere else in the tax code, an employee, the W-2 is considered trade or business. For 199A, the W-2 wages are not trade or business. So it does not qualify for the 20% deduction for a W-2. We'll talk about why that's important as we talk about S corporations in just a moment. So some of the limitations, the code throws in some qualifiers. So basic rule is 20%, and as everybody knows in the tax code, there's always a but. But if your taxable income is more than $321,000 for a married filing joint return, then the deduction becomes, the base deduction is still 20%, But you have to look at the business and say, okay, now what were the W-2 wages that it had? So here's where those W-2 wages for an employee become important. And now you get the lesser of that 20% that you calculated, or 50% of the W-2 wages that you pay. So if you don't have employees, if you're a sole practitioner and you're over the threshold, you may be totally eliminated from this new deduction because you don't have employees. You're doing all of the work yourself. And so, again, we'll work through an example of that in just a moment, but it's, again, below these thresholds, so $160,700 for an individual single taxpayer or $321,000 for a married filing joint. If you're below that, you get to 20%. If you're above that, then there are additional qualifications that kick in. And also the type of business becomes important because above that threshold, they've said if you're an attorney, an accountant, a doctor, you don't get this deduction. So certain services, they say you don't get this deduction. So much more simple for the below the threshold, more complicated for above the threshold. The only limitation at that is that the S corporation must pay reasonable comp, and again, it's a balancing game. And this is where we've consulted with a lot of our clients. Are you paying reasonable comp? If you're paying too much, but you've got other wages, there's a benefit to maybe lowering your salary and planning that to make it reasonable. And we had one instance where we had a business owner who was semi-retired and he was still pulling out $400,000 of salary, and we said, you know, if you lower that to $200,000, which we still think is reasonable for your 60 days of work that you're doing, then you can take 20% of that $200,000 that you're not paying yourself in salary anymore, and that's a deduction. And so we adjusted his comp, documented why we did it, and got him another $40,000 of deduction. So that's some of the areas that we looked at in planning this year. Partnerships, a lot of partnerships are structured so that certain people get guaranteed payments for their services. Those guaranteed payments are the equivalent of wages and are not eligible for the QBI deduction. So looking at those and maybe planning that and determining could we use a different type of structure to compensate people for the activities that they present. And the difference is that an S corporation has a legislated requirement to pay reasonable comp. A partnership does not. So if you can throw wages back up into, or guaranteed payments back up into the ordinary income line of the partnership, then you can increase the QBI deduction. So again, those are some of the conversations we had with our clients this year about how can we maximize that deduction, because again, it's a very, very nice deduction. So we talked about the phase out. The numbers that I gave you were where the phase out begins. This is where the phase out ends. So at $210,000 for single taxpayers, $421,000. If you are an accountant, an attorney, a doctor, you get zero deduction after you go above those levels, just because you're an exempted type of business. At that point, it's also fully phased in that 50% of your W-2s is a limit. So you come down to the calculation below. So first line is 20% of QBI. Second line is the greater of 50% of your W-2 wages, or, and this is kind of the real estate activity clause, 25% of your W-2 wages plus 2.5% of unadjusted basis of depreciable property. And that's kind of what do you have invested in the business that you use to produce the income. So again, that comes in some farms that's come in, but more likely that's coming in with real estate activities, because that's where you have a very high investment in capital and equipment. So also that comes into play in some manufacturers where you have more of a capital, less labor intensive type of business. One of the big question marks we had last year when we spoke was what about the business that's structured the way we've been structuring businesses for years, where you have the the business real estate in a partnership and the business activities in an S corp. You're paying rent to the partnership. Is that a trade or business, and does it qualify for QBI? You own the business, you own the real estate. Fortunately, the IRS did come out and say, yes, self-rental income is qualified for QBI, and you just basically combine the two and calculate the deduction. So that was a very friendly, I mean, a lot of our structures are structured that way, where the real estate is separate. It's rented to the operating agreement. A lot of legal reasons and tax reasons to do that. So self-rental is an activity that the property is owned by the owner, who materially participates in the entity that is renting the property. QBI can be claimed on other rentals. So if you own other rentals, they can still qualify as a trade or business. And there's a safe harbor rule that says, the IRS came out and said, what is a trade or business when you're renting? And they said, we'll give you a safe harbor. And the safe harbor is in your rental activities, if you spend 250 hours, so basically 5 hours a week, if you spend that amount of time, we'll give it to you. That's the safe harbor. And the qualification in that is that it can't be a triple net lease that qualifies if all you're doing is collecting rent and somehow getting 250 hours in. They're going to look at it a whole lot differently. But the safe harbor says that if you get 250 hours and you can document it, so if you're going to use this, we recommend keeping a log of your hours and track of your time, and that 250 hours includes not only your time but any contractors that you hire. So if you're hiring maintenance or those type of things, it doesn't matter that you did them or not, just that 250 hours went into that activity, and we'll say it's a trade or business. So documenting that, not only for you but for your contractors, is very important. The thing that you do to that, if you claim the safe harbor, you file an affidavit, which actually has to have a physical signature and be sent in with your e-file. So that you are, once again, you sign your return, you're saying under penalties of perjury, but you're saying it again on this affidavit whenever you sign it. So I imagine that they will be challenging those at some point in the future and asking for those logs. So after the phase-out range, we already talked about this, 20% or 50% of your wages. Again, that's a planning opportunity to make sure that that businesses get their wages in. So here's some examples. And the first example, D is an unmarried, owns a computer shop. We're going to say it's not a service, so we don't have to worry about whether or not it's a qualified service business or not. So under the first scenario, he has QBI, so his business made $100,000. He has taxable income of $81,000. So as we go to compute the QBI deduction, he gets 20% of his taxable income is one of the limits. So 81,000 times 20% is 16,200, or the lesser of that, or the QBI, 20% of the QBI. So he has $100,000. It's probably his only income. He has standard deduction and so forth that he's taken. So he's got $81,000 of taxable income. The 20% of QBI would be 20, but he only gets the 16,200 because his taxable income is actually lower than his business income because of the other deductions that he's taking. And then scenario 2, he's over the threshold. So very successful business. He has a QBI of $1 million, taxable income of $980,000. He only paid wages of $50,000, so all of this income is on his sweat. It's his sweat earnings, and doesn't have a lot of assets. So his QBI, as we calculated, could be as high as $196,000 because of the 20% of his taxable income, 20% of $980,000. Which is less than the 20% of these QBI. So we'll still have a little bit of a limitation there because his taxable income is lower, but he's severely limited because of the W-2. And this is an area where we've talked to clients, and said, you're a sole practitioner, so you've got this $1 million of income. You can't pay yourself a salary as a sole practitioner, but you can if you're an S Corp. So if you convert this to an S Corp, pay a salary to yourself, those W-2 wages do count towards this. So plus there are some other Medicare advantages to doing this. So this would be one where we would probably talk to the client and say, let's take a look at this and see whether it's worth looking at an S corporation. Converting this to a business to an S corporation could be as simple as checking the box and going forward as an S corp going forward. So this would be an area where that big of a difference might be enticing to the client to look at converting the entity. So one of the things that we're talking with clients about is, are you in the right entity structure? It's become more important under the new tax law than it was in previous years. So example 3, this person is in the rental business. He has rental income of $50,000, taxable income of $150,000. So 20% of taxable income is $30,000. Unfortunately, he does not meet the safe harbor. He is not meeting the 250 hours. So that $50,000 of rental income does not qualify as QBI. It's not a trader business in this case. So the QBID, the deduction, is going to be 0. So in this case, we would be advising them, what are you doing with this? You're getting $50,000 of income. Could we document that between your maintenance and rent collecting and those type of things that we somehow reach the $250 or 250 hour threshold so that you would get 20% of that $50,000. So again, a conversation with them, changing the entity doesn't matter, but their activity does. How long are the HVAC people at the property, and how long are they spending on maintenance? Because that actually counts towards that 250 hours also. So not just you, but your contractors. Are you spending that amount of time?
Brad, on the bottom of that one, you mentioned it's a triple net lease, and so maybe the wording of the lease makes a difference.
Well, yeah, we've actually had conversations with, okay, what's the threshold on a triple net lease? The definition of a triple net lease is that the lease lessor is responsible for paying insurance, taxes, and maintenance. And where's that line as far as changing that lease away from a triple net? You might have the 250 hours, but you don't jump over into the safe harbor because the triple net lease is specifically exempted from that. So one of the strategies might be to let's change the terms of the lease significantly enough that we're not a triple net lease and that the IRS wouldn't challenge that. So good point. Final example, we have a commercial building rent. He leases it in this case to his own business. So business income of $75,000, self-rental of $50,000, total taxable income of $150,000. So as we go through this, the same calculations, 20% of taxable income is $30,000, but 20% of the business QBI is $15,000, 20% of the self-rental QBI, which does qualify, is $10,000. So in this case, he's got $25,000 of available deduction. The self-rental does qualify as an active trader business. There's no 250-hour requirement. There's no documentation other than the fact that you and the business are basically the same. So some planning opportunities, and we mentioned this as we were going through. Review wages and guaranteed payments. We probably had more conversations about that. The IRS always looks at an S corporation, and when they come in, they say, are you paying reasonable comp? And this is one of the areas, again, where depending on where you're at, we talked about a case there where a client didn't have enough wages. That's an area where you might want to increase the wages to the owners in an S corporation so that you are able to get more of the deduction than you would have been previously. Lowering it so that your income goes up and the 20% goes up is another strategy. So it's really looking at that and saying, are you paying fair comp? If you're paying too much, do you benefit from lowering it? If you're not paying enough, do you benefit from raising it? And it's another reason just to kind of get it in the sweet spot of being right. So reviewing those, evaluate accelerated depreciation basically for the same reasons. And then address this in advance of the year-end planning. These are things that sometimes they take a while to adjust. If you just, at the end of the year, you go, oh, I need more wages, and we pay a $100,000 bonus. It looks a little fishier if the IRS comes knocking and takes a look at it. Well, why'd you pay a $100,000 bonus? Well, because I needed it for the deduction. That's not going to fly. So having time to get that in and document it is important to making sure that we can kind of bulletproof that deduction whenever the IRS comes. And again, looking at sole practitioners or Schedule F farmers to say, should you be an S corporation because of this? There are other reasons to do it even after the sunset, but does it make sense to actually change the entity? You've been an F business for a farm for a long time, but does an S corporation now make sense because of this deduction? And then looking at an operating company and splitting the S corp and the real estate, it's always made sense. It makes sense a little bit more now. So some other areas where there were significant changes in the tax code, depreciation, and some other business items we'll talk about. The new tax law put a brand new category of property in, and then they messed it up. So they put it in intending it to be a very taxpayer-friendly item. They intended it to be 15-year property, eligible for bonus depreciation, eligible for 179, and that's what all of the minutes of the committees say. That's what the intent was. If you talk to Congress, that's what their intent was. When they wrote the law, they made it 39-year property, but then they made it eligible for 179 but not for bonus. Because it's 39-year property, it's not eligible for bonus depreciation. We'll talk about that a little bit. So they just flat out made a mistake. They know they did. They're like, oh, we'll correct it, and then they've not passed any technical correction bills. So where we sit right now is qualified improvement property is out there, and what it is any improvement to a building after it's placed in service. So if you're actually people who are building a new building, once you have occupancy permits, anything that you do after that can become qualified improvement property, which from a straight depreciation standpoint doesn't do you any good, but it does make it eligible for 179. And we'll talk about some of the differences between bonus and 179 in a bit. The intent was for it to be 15-year property and eligible for bonus. So hopefully one day they'll actually go back and correct that. But right now we all know that Congress doesn't like each other and they don't like the president, and so getting anything through is iffy at best, and this is probably not the highest thing on their priority list. Bonus depreciation. Bonus depreciation has been used on and off throughout the history of the tax code, and this is actually the most taxpayer friendly that bonus depreciation has ever been in my career anyway. Which goes back a little while, almost as long as Mr. Whatlett. But the law is that on any property that is equal to or less than 20-year recovery period, so that's basically everything but a building, you can take bonus depreciation on both new and used property, and that used part is brand new, that's never been in the bonus depreciation code before, that you can take bonus depreciation on used property and write it off in the year you buy it. And so that's very generous. So if you're a business that buys a lot of machinery or equipment, or you're doing a lot of expansion, not to your building but to your capacity, this will give you a first year write-off of most of that equipment. Most all of that equipment. There's no limits on this. You can create a loss with bonus depreciation, which is nice if you have multiple entities. So it's very taxpayer friendly, and it's a shame that the qualified improvement property that we just talked about isn't included in this. Section 179 has also been around for a long time. They've greatly expanded this. It has a little bit more flexibility. We actually have a chart comparing bonus and 179. It's also a write-off provision and says that you can write off basically any property up to $1 million. This does have a limit. Bonus does not have a limit. And this is, once you hit $2.5 million of additions, the 179 starts to be reduced. But it's 100% write-off. It does give you a little bit more flexibility. You cannot create a loss with 179 like you can with bonus, but you can take your income down to zero. And it is a little bit more flexible in that you can pick or choose. With bonus, if you have property that's in 5-year, 7-year, 10-year, then you can elect in or out based upon the property, 5-year, 7-year, 10-year. You can elect out for 10, in for 5, and out for 7. But it's for the whole category. 179 allows you to pick and choose each individual asset and the dollar amount. So if you bought something that's $100,000 and you only want to expense $75,000 of it this year, you can do that under 179. So a little bit more flexibility. It does not include roofs, HVAC, fire protection systems, or security systems. Those are specifically exempted. So we talked about that chart, the differences between bonus and 179. Maximum deduction per year. Under bonus, there is no limit. Section 179, it's $1 million. Years applicable. Bonus depreciation is set to expire in 2026. You'll see a lot of the stuff that we talk about expires in 2026. 179 does not expire. They made it permanent. It doesn't mean it can't change, but it's permanent. So whatever that means. Can you pick and choose the assets? Bonus, it's mandatory by the asset class. 179, you can pick and choose. Doesn't apply to land improvements. Bonus depreciation, it does. 179, it does not. Applicable to non-residential improvements, roofs, HVAC, the such. Bonus depreciation, no. 179, yes, it does, which I think is the opposite of what I said. I think I read that wrong. It does apply to roofs, HVAC, and to SUVs. This was always President Bush's tax deduction that they always talked about. For vehicles over 6,000 pounds but less than 14,000, you cannot take bonus, but you can take up to 25,000 of a deduction under 179. Can you create, is it limited by the business activity? Bonus is not, so you can create a loss. 179 it is. Pass through owner's active business income. Bonus is not. 179 it is. So,
Brad,
yes.
on SUV, are you saying under bonus the limitation does not apply, or there is no bonus available?
There is no bonus available.
Oh.
And when clients are placing fixed assets into service, these are the things we're looking at with trying to get taxable income to the right number and weigh tax brackets and future year income, things like that, trying to quantify what the deduction's worth today versus what spreading that depreciation deduction out over future periods might do. Given all the things Brad talked about with QBI and different things, it's not always the best answer to write everything off in year one.
It's hard to tell our clients sometimes, or it's hard for our clients to hear sometimes, but zero is not the right answer for taxable income in a lot of cases, because you're throwing away those low tax brackets. And so actually planning those and trying to hit a 20 to 25% bracket is actually more advantageous in the long run than trying to zero out your taxes. Because if you take a deduction now on those 10, 20% brackets that you could take later at a 37% or 39 or whatever the tax rate ends up being, then you've lost out on some of the benefit of that asset. So it's more than just what's my number now. It's looking ahead and saying what's my number going to be. So Okay. Cost segregations in the new tax law became very beneficial, because if you think about it, in a building, when you go in and do a cost segregation, what that does is, and we'll show an example of one in just a second. If you go and buy a building or you build a building, inside that building are a lot of components. And those components, the building itself is going to have a useful life for tax purposes of 39 years. Inside that building and inside that construction that you do are a lot of components that can be at a lower life, 15 years or less, which means, okay, do I take a deduction over 39 years or do I take a deduction today under bonus depreciation if I so choose? Or if I don't choose, do I take it over 15 years, 7 years, 5 years instead of over 39? 39 almost always is not the answer you want, even when you're trying to plan out long-term taxable income. So having if you have a new building, you have new construction, or you buy a building, a cost segregation became even more beneficial under the new tax code than it had before. So a quick example, in this particular case, and it's hard to read, but you had a total acquisition of $1.8 million. And in this particular example, we were able to take the first year deduction from $5,000 to $319,000 by looking at how much of the property is in those 15 and 5 years. Because if you'll look up above, if you just buy the building, you write a check for the $1.8 million, and the accountant writes it in as, oh, that's a building, it's 39-year property, then you're going to take that deduction over the next 39 years. By looking at the building and going in and looking at the plans, our cost seg people said, okay, there's $220,000 of 15-year property, there's $100,000 of 5-year property. All of that can be written off in year one under bonus depreciation provisions. So instead of getting that $5,000 deduction in year one in 2018, the client was getting $319,000. So the after-tax benefit of that is $118,000. So at the end of time, just the time value money, they calculated that the benefit was $82,000 to them doing this cost segregation. In 39 years, you pay the same amount of tax if the tax rates all stay the same, but the time value of money and having that in for your working capital becomes very important. Obviously, if you're building a building, you're using a lot of working capital to do that. Being able to save taxes now and putting some of that back in is a very good benefit of a cost seg. So some simplified, there were also some simplified accounting methods that were added. More businesses, including C corporations, may be able to use the cash method under the new tax law. Basically what it did was raise the range of tax basis accounting. In the past, for a C corporation, it was, if you're a C corporation over $5 million, you have to use the accrual basis of accounting. Congress raised that for C corporations and all other businesses, regardless of the business. If you're under $25 million for 3-year average revenue, you can be on the cash basis of accounting. The advantages of that are that your taxes more line up with your cash flow. A lot of times a business has things like receivables, inventory that may or may not be able to be deducted now, that you pay taxes on later rather than currently if you're on the cash basis. Some other things that went away if you're under 25 million, the UNICAP requirements, the capitalization of inventory if you can treat it as non-incidental supplies, and the percentage of completion for long-term contracts. So again, very taxpayer friendly for things under $25 million. So some examples of accounting methods, and these are, when we look at a new client, this is one of the first things we will look at on a tax return are there more beneficial accounting methods that you can adopt for tax purposes. Depreciable lives and depreciation methods in certain industries. This is a huge one that we find. I think about retail oil and gas, we find something almost all the time, and then restaurants, we find something almost all the time on the depreciable lives and methods that they're using. Accrual versus cash basis reporting, we look at that. If you are accrual and you have to be accrual, have you made the prepaid expense election deduction to elect? If you're prepaying your insurance, you may be able to deduct that in the year you pay it instead of the year that it expires. Are you expensing and capitalizing your fixed assets properly? A few years ago, there were new repairs and maintenance regulations that came out that greatly expanded what you can expense as a repair or maintenance item rather than capitalizing it. And those are things that a lot of firms have not picked up on. And then inventory valuation. Are you using a proper method to do that? So looking at a few of those, and what happens when you change an accounting method? A lot of accounting method changes are automatic, and you just file a form when you complete your tax return. You change the method, you adopt the new method, you let the IRS know that you did that. The new method is accepted going forward. There's no filing fee. It's just there will be some accounting fees, obviously, but it's just a change, and you notify the IRS that you changed your accounting method. If it's favorable, and we did one for a client a few years ago that had $1 million favorable adjustment. They got a check for roughly $400,000 as a tax refund. If it's favorable, you take the impact of it immediately. If it's unfavorable, so we do have clients that come to us and they weren't using a proper method of accounting, and they should have recognized more income, or they expense too much. And so we have to make an accounting method change that is not favorable to the client. Well, we get to spread that over 4 years. And some of the reasons to do that, if the IRS comes in and audits a client and they find that you have a method like this, they will make you pick it up in 1 year, and they'll charge you penalties and interest. If you change the accounting method and you do it properly, then you get audit protection. They can't come in and change it and make you pick it up in 1 year, and you avoid the penalties and interest. So if you're on an incorrect method, it is worth it to take a look at changing it. So again, accrual to cash, just looking at some of the benefits. A lot of service businesses have more accounts receivable than they have accounts payable, and that's kind of the trigger for wanting to do the cash method. And it really gets you on the pattern of paying taxes when you collect the cash. So in this particular, the adjustment was $570,000 for the bottom example. And you know, again, this is a newer provision that has been expanded. A lot of clients that weren't eligible before are now eligible for the cash method of accounting, and it will create a tax deferral.
I think last year in our office, we probably had 15, 20 accrual to cash method accounting changes. And again, the first test being that receivables versus payables, and sometimes you even have to dig a little deeper than that, because if those payables relate to inventory, which is going to stay on the balance sheet, it still might be hidden in there that would be a benefit to you. So, and you pick that up that one time, and it really doesn't come back until you maybe sell the business down the line or something like that. It's really a one-time pickup, and then you're on the cash method going forward.
Correct. I mean, a lot of people look at this and they say it's a temporary method change, and it is. It's temporary until you don't have any receivables anymore, and then it reverses. But it will always have a benefit as long as your receivables are greater than your payables. Another area that we see a lot of method changes are in the depreciation area. And this is actually a client that we had that was depreciating software. Software is being depreciated over 15 years. When we sat down and talked with them and found out what it actually was, determined that it should have been over 3. So it should have been fully depreciated, and we looked at it and said that We could do a 3115 adjustment. We did a 3115 adjustment, adjusted downwards the basis in that software, took a current year deduction of $1 million. That flowed through to the individual. They were quite pleased with the deduction that they got. New credits. This is a new credit. We haven't seen much of this yet, but it is something that if you do provide family and medical leave, the employer now can take a credit for the amount paid for family and medical leave that's under a written policy. So you have to have a written policy. Credit starts at 12.5% and will go up to 25% of the wages paid to the qualified employee. So again, this is something that if you provide medical leave for your employees, take a look at this credit and see if you're eligible for it. The maximum amount of leave is up to 12 weeks. So it is a new credit to encourage people to pay time off for family and medical leave. Health reimbursement arrangements are available beginning in 2020. These are employer-funded group health plan that reimburses employees and their dependents for medical care expenses they incur on a tax-free basis. The HRA by itself does not qualify. It is different than an HSA, so this is something that Kyle, you may know more about these with the Advantage Group than I do. So,
yeah, it's a good option for smaller employers. Basically, they were taken out of favor or weren't eligible. You couldn't have a health reimbursement arrangement when some of the Obamacare and the Affordable Care Act laws came out. So now the IRS has looked at those and said, hey, this is a good way for employers to be able to partially cover employees' health care. So if you don't offer a full kind of normal coverage health plan, this is an alternative that might be a good option.
So some business planning opportunities. Look at the QBI. It's a nice deduction. Are you maximizing it through wages and so forth through your depreciation deductions? Have you evaluated accelerated depreciation methods? Those are out there. They're new. Are there any new credits available to you? Work opportunity tax credits, not one we talked about today, but a lot of employers might qualify for that by hiring veterans or certain classifications of employees, and whether or not you take that credit. And then consider setting up an HRA or looking at that family medical leave credit. It's also a new one that's available. If you're doing that, then you might as well take the credit for it. So before I pass it on, any questions?
You talked about S corps and C corps. What about limited liability corps?
Well, limited liability corps exist as a state law, and they're a legal entity, but they are taxed either as a partnership, an S corporation, or a C corporation, depending upon how you've elected. So once you establish an LLC, it's taxed as one of those three, and it abides, it abides by those laws. So if it's taxed as Can you finish my sentence?
There you go.
So ultimately,
Tough question.
Got me all choked up.
bum leg and a bum voice. No. Ultimately, the LLC, like Brad was saying, is a legal entity type, and it would follow the laws of either the C corp, the S corp, or the partnership. And so, whether you're talking about QBI or some of the other things, would follow whatever particular bucket it falls into.
And I have one other question as far as if you're a licensed real estate broker, it used to give you benefit of always being active real estate rather than passive. Do you know if that's changed?
That has not changed.
Did everybody hear your question?
QBI calculation, does percent of ownership come into play?
Thanks, John. I'll repeat the question this time. So that question was about real estate professionals, and those rules have not changed. The question here is, does ownership come into play as far as how the QBI is calculated?
Yeah, the percentage.
It does not. Outside of your ownership percentage, with some of the factors that Brad talked through with wages and the unadjusted basis and the assets, you're allocated your percentage ownership. So if you own 10% and they have $100 of wages, let's say, you would get $10 that passes through to you, and that $10 would be what's used to calculate QBI on the individual return. Any other questions?
Okay, so we're going to talk about some Wisconsin and state tax matters. So I'm going to talk about three things. That pass-through entity election, which got put into place by Wisconsin in December of 18. Wanted to touch a little bit about sales tax, state sales tax, and Wayfair versus South Dakota decision, and then talk a little bit about Wisconsin and tax reform and whether we're in conformity with all the changes that the IRS made or not. So the pass-through entity tax election was some legislation passed in December of 18 by Wisconsin, and it allowed flow-through entities, S corporations or partnerships, to make an election at the entity level to pay their state tax at the entity level, as opposed to having that income flow through to the individual and having that tax at the individual level. So why would they do that? And the reason relates to probably some things Kyle's going to talk about. At the individual tax level, there was changes to this standard deduction and to itemized deductions. And one of those changes was that when you do your itemized deductions, there's a component of taxes, and that taxes piece was made up of real estate taxes and state income taxes. And that piece is now limited to a maximum deduction of $10,000. So at the individual level, if I flow through all that income to my individual return and I've got $30,000 in state taxes, which kind of resulted from the pass-through of that entity income, I now can't take a deduction for that because I try to itemize and I'm limited to $10,000 even though I paid $30,000 in tax. And so what some of the states did was try to do a workaround to that federal law change and say we still want to allow the deduction of that state tax somehow that they're not getting at the federal level. So Wisconsin came up with the workaround that says, hey, if you make this check-the-box election and have that S corp or partnership be taxed at the entity level, you're able to pay the state tax at the entity level and deduct it against your federal income as a corporate tax. And a lot of states did that in some form or another, and that was, Wisconsin put this in place late in December of 18. For S corps, on the bottom line there, it applied for 2018. For partnerships, it first applies in 2019. So as we were doing late last year in 18, we were certainly looking at all our S corps to see if this applied, if that would be a good method to be able to save some taxes by making this election.
So Pete mentioned a couple of the other states are trying to do this too, and most of those are on the East Coast. And their plan is more around making a charitable contribution in exchange for the state tax benefits that Pete talked about losing out on. Wisconsin plan, obviously a little bit different. The IRS has very proactively challenged what the states on the East Coast are doing. New York and Connecticut, I think specifically. The IRS hasn't blessed this per se of what Wisconsin has done, but we think it's a much better answer than what some of the other states have come up with.
Yeah, absolutely, and this could get challenged at some point, but at this point, we're moving forward with our clients making this election when it's appropriate and it's a tax savings opportunity for them. So the advantage is it's easy to do. It's an annual election. We can make it 1 year when we have income, and the next year when we have a loss or limited income, we don't have to make the election. And I'm going to show an example here in a bit, but it's possible that we could save up to 6% of our combined federal Wisconsin taxes if the facts line up correctly. But there's a lot of nuances to that simple check the box and have that apply and be of tax benefit. There are nuances to that. And so the disadvantages, and these are some of those, that the tax is paid at a rate of 7.9% when you make the election. So you're paying at the entity level at 7.9% as opposed to letting it flow to the individual and only paying tax on that income at, let's say, 7.65%, which is the top individual rate. So there's a little bit of rate difference that we have to deal with. There's also the loss of certain credits that if the income flowed through to you individually, there's a manufacturing and agriculture.
Yeah, it's hard to say. I mean, obviously, the question was, what's the long-term viability of this election in Wisconsin? And so I think, you know, the IRS is challenged for manpower right now, but certainly it's going to be something they're going to look at. They've very vocally protested kind of or challenged what's been done on the East Coast. So I think we have a higher likelihood, but it's certainly not a guarantee that in the long term this will hold up. The other thing to consider is who knows how long these itemized deductions limitations on the federal side, you know, if we get a new Congress in 2020, new president, it might be only 2 or 3 years before the tax law changed, and that's back to kind of how it used to be, where then this election wouldn't make sense.
Certainly, if it's in place, no matter how long it is, you know, it's a real permanent tax savings for us. So it's certainly something we look at pretty closely. So this election on the right-hand side, you see if there's no election made, we've got our S Corp that made $100,000 and it flows through to us and we pick it up on our federal and state return. So on our Wisconsin return, we're in the maximum highest tax rate. You know, we pay tax at 7.65%. We pay $7,650 to Wisconsin. And over on the federal side, you know, we pay tax at 37% of that $100,000. We don't get any deduction for that state tax we paid, because if we don't itemize or we're limited to $10,000, I'm basically assuming we didn't get any benefit for that state tax paid. So, you know, the $100,000 times 37%, $37,000 plus the state tax, we paid $44,650 in tax. Now, if you move to the left side and say we made that election, you can see we're paying Wisconsin tax at a higher rate, 7.9%. But then we get to deduct that $7,900 against the $100,000. And now our taxable income federally is the 92.1. Apply the maximum rate of 37, kind of do the math there, and you can see our total tax is now $41,977. So we saved $3,000 on that $100,000 of income. So certainly you can do the math. If those numbers are higher, the benefit can be pretty substantial. And again, it's a relatively easy election to make. It's, you know, we would have to go through all the mechanics of paying quarterly estimates to the state at the entity level and some things like that. So there's a little bit to it, but not much. And certainly the tax savings can be pretty substantial. So.
Couple of other things to add, Pete. The individual tax rate for Wisconsin doesn't jump to 7.65% until you get up to, I think it's like $325,000 of income. So below that, when you're only paying 6%, the math doesn't quite work out. So I think that's kind of what we've seen is if you're north of $300,000 of income individually, that's where this starts to make more sense. And the other point to add is, for this analysis, the 37% tax rate on a married filing joint return doesn't kick in until $600,000 of federal income. So we're trying to compare, just in the most simplistic example here, that $100,000 being taxed at the top rate, but it kind of presumes or assumes that you've got another $500,000, $600,000 of income to truly get to this, you know, maximum savings or potential savings of $3,000.
Yeah, absolutely. It's like most things. I mean, these are things you should be talking to your tax advisor about, and certainly if the fact pattern's right and your income's pretty high, it can make a substantial difference. So I wanted to talk a little bit about sales tax as well. Go ahead, question.
So just to clarify, I think what you're saying is you're treating your client's tax returns as if that is the law. If we made the election until the IRS overruled.
Correct. It is the law right now. So yeah, I mean, could the IRS come in and overturn?
Yeah.
Possibly, but again, we can only proceed as the law is right now.
We certainly, I mean, all that is based on the taxpayer's individual risk tolerance, right? I mean, if we kind of walk through what we've described up to this point as far as what the states on the East Coast are doing and what the likelihood is, and we think it's a potential option that will stand in the long term, but the client is the one making that decision, kind of with us providing the whole fact pattern that we've talked through.
So a little bit about sales tax and this Wayfair decision. So it used to be prior to that latest sales tax decision that sales tax nexus was based on a physical presence test to create nexus, to create this ability to have that state tax your transactions. And so it related to the solicitation of activity in that state, or real or tangible property that you owned in that state, or you physically went there and performed services. So unless those things happened, it was difficult or it was the way the law was, those states could not create nexus and have you responsible for sales tax for activity in that state. And then there was this Wayfair case, South Dakota versus Wayfair, and it created an additional type of nexus. You know, I think internet sales. I mean, it's just economic nexus. It's not. It overruled the physical presence test of the prior law and created a different set of facts. And so, basically, this related to just sales to that particular state. And so, down at the bottom, the way the South Dakota law worked was there was a carve out for a small amount of activity. So if there was less than 100,000 sales or 200 transactions, then it did not apply. But if it were over those thresholds, then you were subject to sales tax in that state. So the U.S. Supreme Court liked the approach there, and it addressed this whole idea of, again, internet sales and where should they be taxed. So after that case, most states, I think 42 at the time of this slide, which might be a little bit old, had jumped on board and created laws in their states around sales tax and remote sellers. And so most states carved out this similar type of threshold, which on the bottom there you can see Wisconsin did the same thing, and they kind of, as of October 1st of 18, Wisconsin's enforcement date, if an Illinois company has no physical presence here but has internet sales here in Wisconsin, and there's over 100,000 sales or 200 transactions, they're going to be subject to Wisconsin sales tax. So as Wisconsin companies, we need to look to the other states we do business in and see what their thresholds are and start to look more closely on, do we have sales tax exposure in those states? And those right now don't translate to income tax exposure, but just sales tax exposure. But on the next slide, I put kind of what's to come, and I think the bottom one there says impact on income and other state taxes. But certainly there's changing trends in these transactions and thresholds, and most states are looking for additional revenue, and so they're looking to who's doing business in our state. And so, you know, as a profession, we've seen more audits and inquiries from other states to our clients with, and maybe some of you have seen this, a checklist of, are you doing activity in our state? It might be 3 or 4 pages long, and it gets pretty granular about the types of activity you have in their state. They're trying to determine whether you have nexus in some form or another for sales tax purposes or income tax purposes. So, you know, yep.
So if I'm selling from Lake Geneva to all these states, is it 200 transactions aggregated in the United States or 200 for each state?
Per each state,
Okay.
yeah. So we have a sales tax, or a SALT team, state and local tax team within the firm, which has always been quite busy because nexus is a big issue with states and trying to get more revenue into their states. But certainly we've done a lot of analysis for clients to help them determine what level of activity they have in those states, what level of exposure, and try to help them determine whether they have responsibility in those states and what their what level appetite is for filing in those states that clearly they're over, or maybe they're right on the border, or they might be in the future. So state and local tax is a big part of our practice and continues to grow because of cases like this. So the bottom line is, it's something that you should review and at least be aware of. And if you think you've got exposure, it might be worth talking to your professional. So my last slide was just about Wisconsin and tax reform. So Wisconsin has static conformity, which basically means it updates itself to the IRS code from time to time. And it updated itself for the tax reform other than some specifically decoupling positions from the IRS tax reform. For the IRS, for Wisconsin, there is no Section 199A deduction at 20% deduction, and there is no 100% bonus depreciation. So those are things we have to deal with in terms of differences between federal and state, and certainly being aware of them and planning around those issues as well. There are other things where Wisconsin specifically decoupled, but these are the two major ones that affect our clients. So that's it for Wisconsin. We're going to move to Kyle with individual.
So the impact on individual returns, I know we've touched on a few different things along the way, but just wanted to provide some graphs or fact pattern for what the true change was under the new tax law from 2017 to 2018. So in general, the reaction to tax law rate was really positive, really favorable. It seemed like tax rates were going to be cut across the board, which for the most part they were. I'll show that in just a minute. But then we got to tax season, right? And February hits, and the media starts picking up on, well, tax refunds are smaller. Tax refunds are smaller. This new tax law is negatively impacting the American population. But really, what happened is, right, we were returning. Or through the changes in the payroll withholding tables, more money was going into people's paychecks every 2 weeks, but they forgot about that for the last 6, 8, 10 months of 2018, and then all of a sudden, where's my big check from Uncle Sam? I must be paying more tax. So that was something that we were talking through with a lot of clients, and it's just another kind of perceived misconception within the media and what's being picked up on. So it's interesting to see just people's reactions and what kind of gets out to the general population. But ultimately, at the end of the day, as you're probably all aware, it's not really the refund that's what's important. It's the actual tax dollars that you're paying in throughout the year. So this slide talks about those refund amounts, and basically across the board, they were less, regardless of what your taxable income was. And then this slide here talks about the actual rate cuts. So I think we mentioned, but the top tax rate used to be 39.6%. It went down to 37%. For example, at about $300,000, you used to pay under the old tax law about 33%. That's now capped at or maxes out at 24%. So kind of across the board, about a 1.5% decline in the effective tax rate, 2018 versus 2017. With the exception of those that are between $250,000 and $1 million. Actually notice an even larger tax decrease. So that effective tax rate is essentially your total tax divided by your taxable income, what kind of average tax rate you're paying, as opposed to the tax brackets, which is what the rate is on kind of your last dollar earned. One of the other things with the new tax law was quite a bit of simplification. I think everything we've touched on today has been the areas of tax law that didn't get any simpler, especially QBI, a huge component of tax reform and one of the more complex revisions that exist. So one of the things from simplification standpoint is the changes in the itemized deductions, right? So the charitable contributions didn't really change, but like Pete mentioned, taxes are now capped at $10,000. And not a lot of change in the mortgage interest deduction, but some. But in Wisconsin, as a relatively high tax state, we saw a large number of returns that formerly itemized that no longer itemize. So this chart just shows the significant decline in the number of taxpayers that were itemizing their deductions through May from the IRS's standpoint. So I think from the standpoint of the postcard and simplification, it did help on that front with the changes in the itemized deductions.
Is that national or state?
This is national information. So opportunity zones, this was a new provision under the Tax Cut and Jobs Act or tax reform. It's an incentive to invest in low income areas and communities. So what it allows you to do is take capital gains and reinvest them in real estate or projects that are determined to be low income by census tract information. So there's not any in Walworth County, but there are a number of locations within the surrounding counties. But what it allows you to do is defer current capital gains. So if you had a large transaction or a large capital gain that you wanted to avoid paying the tax on, you can turn around and put it into this opportunity zone fund, which would allow you in the short term to defer the capital gain. If you hold that for 5 to 7 years, there's some partial gain forgiveness. And then if you hold it for 10 plus years, that investment, you can have the entire amount of appreciation forgiven. So there's kind of some permanent tax savings in there if that's something that potentially you're looking to invest. You can invest non-capital gain funds. The tax benefits of those are just limited because you don't get the full opportunity that you would should you invest capital gains. And that's something, talk about the power of the firm. We have individuals within the firm that are spending 90+% of their time on just these funds alone. So if that's something that you are interested in, certainly talk to your advisor, talk to us. So individual tax planning opportunities, what are some other things to do? Obviously it starts for business owners with the pass-through entity planning. In most cases, that's where the vast majority of their income comes from. So all the decisions that you're making, things that Brad and Pete talked about, obviously the true impact is felt on the individual return. So when we're making those decisions, we're trying to forecast through what that looks like on the individual return and what is the impact to the taxpayer. I mentioned the charitable contributions and the increase in the standard deduction. One thing that we get a lot of questions on are what can I do with my charitable contributions? How do I still ensure that I'm getting benefit for those? So if you're over 70 and a half and you're making required minimum distributions, one option we've seen for a lot of clients is to make a direct or qualified charitable distribution. So that's having the IRA manager directly write checks out to the charities. And what that does is it allows you to exclude that IRA distribution from your income. And you don't get the charitable deduction as an itemized deduction, but because you don't have to claim the income, it doesn't matter if you're itemizing your deductions or not. You can double up your charitable contribution, so maybe you give $5,000 a year, do $10,000 in 1 year so that you potentially can itemize, and then in the next year don't do any, is another tax planning strategy. Maybe set up a donor advised fund, so that's taking a pool of investments, putting it into this qualified donor advised fund, which gives you the immediate charitable benefit, even though you don't actually make the donations to charity for until the next number of years in the future, whether that's 5, 10, whatever it is. But again, kind of front loading those contributions gives you the immediate tax benefit, but allows you to spread out those contributions over future years. Or you can donate appreciated stock. By doing that, you're able to exclude the capital gains on any holdings. So if you have an investment that you turn around and sell the stock and then turn around and write a check to charity, you're recognizing capital gains on that appreciation, and then the offsetting charitable contribution, you can kind of skip that gain recognition if you directly give that to charity. Be aware of annual income fluctuations and corresponding phase-outs. Brad talked a lot about the QBI phase-out limitations and what can happen, but you want to try and streamline or keep your income consistent. If there's large fluctuations or jumps either up or down, over time that's going to cause you to pay more tax. For example, if you had $500,000 of income in 1 year and $100,000 the next, or zero the next, let's say, versus $250 over 2 years, you're going to pay less tax if you put the $250 split over the 2 years than having one large year of income and not paying any in the next. So a lot of times that's something we'll do is we'll forecast out a couple of years for clients to try and streamline that and say, okay, what's the best year to buy an asset, or what's the best year, or how do we maximize the QBI deduction over those couple of years. And then talk to a professional tax advisor. We get a lot of questions, and being able to help talk through things with clients and plan years into the future. It's not just about the short-term decisions, but longer-term planning, succession planning, exit planning, which is what John's going to cover. Not quite yet, I guess. So the other thing Pete asked me to touch on is Bakertilly Advantage. This is Bakertilly as a large firm kind of redefining ourselves towards small business. So it's using, which we don't really define the term small business. It's not like we have a revenue threshold or anything like that to classify what small business is, but it's typically clients that don't have a CFO that maybe need some help with their accounting or more CFO level consulting type transactions. So the most important part of this is getting your books and records accurate, because without accurate books and records, it makes the tax planning piece very difficult. So we've been able to come into clients and help look at technology and how do we look at outsourcing their accounting to get better data to use, real-time data to make current decisions looking ahead. So in today's economy too, with hiring and looking for people, we've seen clients with a lot of turnover, and maybe they've had an AP clerk that they've had to fill that position 3 times in the last 5 years. We can help bring technology solutions to the table where that might eliminate or shift some job responsibilities that Bakertilly can become your outsourced accounting solution for AP processing or whatever it might be. So this slide just addresses, given that cloud technology with Bakertilly and management having real-time access, we can be more proactive in some of our advisory services and looking ahead with what the business owner might need or want and analyzing things like that. So it just helps give everybody better information, which allows you to make better decisions. It's all scalable, so the technology, we have clients that are very small and clients that are very large using multiple integrated technology systems when it comes to general ledger, bill pay, expense reimbursement, things like that. And it just allows the business owner to get back to running their business. One other piece that we have is kind of the HR consulting side of Bakertilly. That's our Vantagen practice. So without a dedicated HR professional in a small business, it's difficult to make sure you're compliant with all the laws and regulations. That's another nice add-on touch that we've been able to create with Bakertilly Advantage to be able to help serve small business and really be advisors so that the owners aren't running in 15 different directions, trying to take care of the accounting and the HR and all of that. This slide is just an example of what the dashboards that we use within a product called Intact to help just give you more graphical information, a little bit easier to read. You can get it on your phone, on your iPad, things like that, where it's not looking at the traditional balance sheet and income statement, if you will. It's customizable. It's got KPIs, key performance indicators that you can use for individual people, whether it might be your sales manager or the owner or the operations person that's on the shop floor. So this slide just lists out kind of, again, the scalability of this, all the way from bookkeeping services up to tax services and CFO, again, high-level consulting and down to data entry. We're doing all of this for clients right now and can scale it to whatever your needs might be. The service approach or the needs assessment is the most important part of this process, where we'll come in and meet with clients, understand what they believe their needs are, what their most important metrics are they're using to run the business, and sit down and walk through those processes, talk to the other key stakeholders within the business, and then develop a tailored implementation plan to bring the right technology solutions to the table to be able to implement a full or partial outsource of the accounting function. So this can be, a 3 or 6 month process. It just depends on how involved the client is. but we want to do it right on the front end and make sure that, you know, we're walking through and understanding all the challenges and pain points and resolving those to make it most efficient for the client. One other piece is payroll. We have a preferred provider agreement with ADP. So ADP is the largest payroll processor in the country. And so that allows us to kind of use their engine, if you will, for processing payroll, but Bakertilly staff resources to be kind of the front line. So you're not calling ADP to dial into a 1-800 number to talk to somebody wherever in the world they might be. You're talking to somebody in Wisconsin to help resolve and fix whatever payroll type issues you have. So, and because of the volume, we get a pretty nice discount. So it's all set up with kind of a flat monthly fee, very straightforward and set, and includes all of your quarterly and year-end reporting. So I mentioned the cloud-based tools. These are just some of what we use: QuickBooks Online, Sage Intacct. Expensify is credit card activity reporting, employee reimbursement. I mentioned ADP. Bill.com is the AP and AR processing software that we use. So that helps process payments, make ACH payments or EFT payments without having to mail checks. So it's been a nice addition. Again, it's kind of, Bakertilly is we have a lot of large firm resources, but this is reinventing ourselves a little bit to be geared towards small business. So,
excellent. All right. Excuse me. All right. So I work at an accounting firm, John Lowe. I'm not an accountant. I am a reformed attorney. I was an estate planning attorney for an awful long time. What I do at Bakertilly from across all of our Wisconsin offices is assist with wealth transfer. Businesses is what I'm going to talk about today. Equally important is simple estate planning. You know, my colleagues have spoken a great deal about all the things that come down with tax planning. If you're running a business or owning a business, it is incredibly understandable that these things don't cross your desk very often. They're not at the top of your to-do list. Unfortunately, we see results where, as a result of it not being at the top of the list, it's a problem. We are in a unique position, my colleagues are in a unique position, in that they're at these companies often enough to continue to say, have you thought about what happens if you can't make it to work tomorrow? Succession planning for the business is important. I get it, inertia happens and this falls down the radar. Equally, you know, I say the same thing and I make the joke, and it's sadly not a joke. I have 3 siblings, each of whom has 3 kids. None of them have an estate plan, and I offer it every Christmas. This was a free estate plan for you. Just get it done. So I get the fact that these things they can fall down the radar. What we do is try to get people to address these things. If not formally, at least map out a plan. In a perfect world, we're going to have a written plan. Everybody's going to be aware of what happens. So generally, what is succession planning? It's simply planning for when the owner exits the business, how the owner exits the business, and how the company looks going forward. Important to point out that there's 2 components to this: ownership and leadership. My brother-in-law is a leader of a company, but not an owner. He is the full-out leader of the company, and over time he gets a % or 2 of the company each year. The family sits in Florida and collects checks as a result of my brother-in-law's running of the business. It's planning for both, and we're going to address that in just a bit. Done right, succession planning meets the objectives of the owners departing and the leaders coming on. I think done wrong, and sadly we had a case not too long ago out of this area where a business owner died absolutely unexpectedly in an accident. And he was a contractor and had several folks working for him, and the business died. We ended up selling off parts of the business, and the building was sold. So he had never thought to plan, or he had probably thought to plan. I had never met him, I helped with the estate and the closing down of the business. So, good. What are your options? And generally, we try to make this as simple as possible, and I'll address each of these three. When I speak with a business owner who's looking to leave, I say, hey, there's really three options. You can begin to gift it, and if you're gifting it, you're going to be gifting it to a family member in all likelihood, in all the great likelihood, to start to give up some of the money. But I want to create a class of stock, if there isn't already a class of stock, that allows me to be the voting control of the company. So, quickly, I'll just address each of these avenues. Gifting. This is really a very common approach, especially in businesses that are moving from generation to generation. It's the easiest approach, frankly. In the course of a day, if you own an LLC, in the course of a day, you can have that LLC in someone else's name. You simply take the units that are in your name and retitle them in the name of somebody else. The gift is accomplished that quickly. A couple of things to think about. If you gift all or some of your company, you have to be aware or have to have arrived at a point in your mind that financially you're going to be able to not collect the resources that were coming through the LLC or the S corporation shares. We try to model these transactions for our clients and show them numerically just how this would impact them. Gifting is, the IRS allows us to give away assets on an annual basis. There's an annual limit. It's $15,000. If I had the money, I could give each of you $15,000 and I wouldn't have any tax implications. Each of you would receive the $15,000 gift and not have to put it on your individual income tax returns. We do have very wealthy clients who maximize their giving. If you're worth, well, here, I'll jump to this point. That's the annual exclusion. There is also something called the lifetime exemption. And the IRS has basically said, Congress has said that if you are what is now considered 1% of the population has a wealth over $11.4 million. If your wealth is over $11.4 million, we're going to tax every dollar after that at 40%. And when you die, we will take 40% of that wealth. So we have clients who are 20s, 30s, hundreds of millions of dollars, and their estate tax burden could be tens of hundreds of millions of dollars. So we try really hard to avoid that. For the majority, 99% of America, we are under that 11.4 threshold, and we can give away all 11.4 during our lifetime, or we can hold it until we die. So if you have a business that's worth only $1 or $2 million, or even $10 million, and you're married, you can protect up to $22 million. So many of our smaller clients do simply make gifts of their units or their shares to the next generation. We report it on a gift tax return and say that we went past the annual $15,000 limit. If you make a gift of 1.4, for example, we would tell the IRS that my 11.4 lifetime exemption has now dropped to only $10 million. So gifting is something that we do an awful lot of. One thing that's really important that when I began practice, the estate tax was 55% and it was over $600,000. So almost every client I dealt with was paying an estate tax or fearing the payment of an estate tax. So we gifted assets a lot, and we didn't worry about what happened with the capital gains. So if I have an LLC that holds a building that has a basis of $100,000 and the property is now worth $1 million, and I transfer that to Brad, Brad's got an LLC now that if he collapses it after I gave it to him, he's going to have a $900,000 capital gain because the gift does not alter tax basis. So in the past, we didn't care about that or cared much less about that. Now, with the exemption as high as it is, our concern is equally as focused on the income tax. And in that case, it doesn't make sense to me unless there's a really great need to give Brad that building. I would rather hold that LLC until death, capture the step up, and then Brad would inherit it and be able to sell the building the next day without capital gains. So we really are methodical in our approach to gifting and discussing, does it make sense to hold this to death or does it make sense to gift during lifetime? Again, for any client of ours who's well north of that $20 million, we are going to try to make as many gifts as we can do. As I mentioned, the recipient of the gifts they're gift tax free. Most times our givers, our donors, are not paying gift tax because we have that $11.4 million exemption. The next point is a really important one. Depending on the structure and the recipients, gifts can also be creditor protected. And this one really resonates. I'm meeting today with a very wealthy family who literally back in 1840s, their family struck gold. And the family tree is amazing. And this little family tree is worth $75 million. And the mother, the matriarch, is sitting on this and passing it to her 3 daughters. And she is terrified of the fact that $25 million for each daughter becomes very attractive in a divorce setting. So we're talking an awful lot about creditor protection. And the point I like to make with clients, and it's the point that my wife and I have done with our estate plan for our son, is a trust for the benefit of a recipient is going to be creditor protected. I took a phone call earlier this week from a friend of mine. His father and family own a bank, and he had received shares in the bank over time, outright, in his sole name. He was getting married, 13 years ago, and I helped him with a prenuptial agreement in which we classified those bank shares as his individual property and not divisible at divorce. Divorce is happening. We are in a spot where the wife's attorney is alleging that the bank stock has now become marital. And it's not a terrible argument. Had the dad given the shares to the son in a trust rather than outright, I could assure the client that those shares would not be reachable in a divorce setting. So we try really hard when we make gifts of a substantial business or a very important business to make gifts to a trust. Trusts are onerous. They're cumbersome, I admit that. But if we can create a trust that mimics outright ownership, then I think we really win because the recipient is going to almost have full control. He or she can be the trustee of his or her own trust. He or she can take income as needed, but if there ever comes a creditor or they're in a divorce setting, they can simply close their arms as trustee and say, I'm not going to take funds for a while. I'm going to let the divorce settle, and then I'll become a beneficiary again. So we try really hard to talk about creditor protection. One last thing is, for those businesses that are so valuable that we're trying to minimize the transfer impact, we take what's called a valuation discount. And it simply says this: if I've got to build a business that's worth $50 million and there's 1,000 units, I'm really bad at fast math. Is that $5,000 a unit? I don't know. Let's say it's $1,000. 1,000 units at $5,000 a unit. I think it's 50,000. If I give you one share, you are a 1% owner in the business. My math is terrible. I'm an estate planner, not a... It is not proportionately equal to 1/100th of the business, because if you went to try to sell that on the open market and you said, hey, I'm going to give you a chance to buy a 1% share in a company that you can't control what wages are paid, you can't control when dividends go out, you just sit quiet and wait for money if we send it to you, no one's going to pay $1 for that. We take valuation discounts, and we would diminish the value of that by sometimes as much as 35%. And we would say, and this is in a family setting where mom and dad or grandma and grandpa have built the business and it's trickled down and now we're giving it to grandchildren. Those shares are going to be discounted for valuation purposes. The IRS doesn't love those, and we are in audit right now on several transactions where we have discounted the value of the gifts. I guess the last point on this slide is for, back one slide, I'm sorry, Pete. No, go, there you go. The ownership, the senior generation frequently will say, I'm willing to give up non-voting control of the company, but I want to retain voting control of the company so that I can make sure that I still dictate where the company goes. So family, we gift often. We do find situations where the senior generation can't walk away from the money. They don't have enough resources, so they have to sell their business to the next generation. We help an awful lot with these techniques. Outright sales, of course, we're going to have a capital gain on an outright sale. The next 2 bullet points, these are far beyond the scope of this conversation this morning, but these are items in our toolbox that we use a lot. And these are techniques that are very sophisticated, and they allow the departing owner to get resources back for their shares or LLC units in a way that doesn't have the capital gains implications, but really not today. I'll leave it at that. Again, in terms of selling, we do still value discount, and we see senior generation keeping voting control as often as we can. These are rather self-evident. When you give a family business to a child, the pros are the legacy of the business remains, the business remains intact, the family remains wealthy, they don't give up control. Obvious downsides, if an entitled child who has never run a business comes in and succeeds to ownership in the business, there's a fair amount of outright hostility sometimes to a child who doesn't know what he or she is doing. Management members might undermine the child. So just kind of an assessment of the pros and cons of doing that. We take an awful lot of our clients through a sales process. We have assisted, and Brad and I were working on a client who employed some of the techniques of giving away shares in the company before a sale. He gave it to trusts for his children. The company was subsequently sold at a great profit, and the children's trusts accrued to the benefit of an awful lot of money. So we assist at Bakertilly with positioning companies for sales. We can sell to management. If you sell to management, of course, you're going to have gain. Sales to third party, gain. Sales to family member, gain, unless we talk about a trust, which is where we could possibly do some capital gains avoidance. When we talk about selling to management, this is a goal of many clients of ours where children are not showing interest. They say, look, I've had a business for 30 years, my kids don't want to be in this business, but I have 4 or 5 employees who are really key to me, and I would love for us to be able to sell to them. We model this all out. We talk about the tax implications of doing so. What it does, of course, is it provides rewards, incentives for the managers who have worked so hard. They are very likely going to have shown over a long period of time that they're capable of running the business. They have the leadership skills, the management skills to do this. When we do make these sales internally, if the shares are minority shares, we have to value discount them. So we would say to the purchasers, you're able to actually buy a share in the company at a discounted value. And when we do these transactions, we have to be very careful because the IRS would like to attribute a sale at less than fair market value as compensation to the employee. So we need to document up the value of the company, and we get a written valuation report when we make these transactions. These are, I have a few minutes left, right?
Yep.
Okay. I won't run through all of the considerations when we're selling to management. I will make the point in the pros and cons. The business remains intact in the same fashion. One of the things that's a con in the setting where you sell to management is that it's pretty tax inefficient, because in all likelihood the managers, unless they have money that is sitting in a bank or a brokerage account, they're going to have to take resources that are coming to them through the company after tax and pay the money back to the senior generation who's departing. So we have after-tax dollars paying money back to the senior generation, which will then result in a capital gain. So it's somewhat inefficient, but in that setting it has to happen. For sellers who really want to tap out quickly, the last point in the cons is a worthwhile point to mention. You're going to need to stick around until the management can make full payment. So it's not as if you can just tap your hands and say, I've sold to a third party, take my $10 million and walk away. You have to wait until the company continues to make payments. So real quickly, this is pretty obvious. You can turn to an outside party and sell. We assist an awful lot in making companies' financial records and statements look really strong, increasing EBITDA so that when the sale happens on a multiple of EBITDA, we have a really strong company to sell. We've taken an awful lot of companies through this approach. One of the things that deserves mentioning is simply what happens if we do nothing. If we do nothing, we resort to state law about how the company is owned. And in the case of the individual, he was a 100% owner in the company. Only his name was on the shares of the S Corp, and he also had an LLC that operated the contracting company. When he died, those shares, without passing to his wife because she wasn't a joint owner, those shares and LLC units ended up in probate court. Probate court is public. Competitors of his, and this is not uncommon, competitors of his in the industry would love to buy his trucks, would love to buy his client lists. You can go down to the probate court and dig into a competitor's files and say, what did they value the business at? And you could make a run at it, 60% of the value, 50% of the value, because you know he's passed, he's the only owner. So probate is a really bad setting for business owners. If anything, find a way to put it into a living trust or a revocable trust, if not something more thoughtful. Jointly held assets don't go through probate when one spouse dies, they go right to the other spouse, so that's a simpler option. Important to point out that for those who do nothing and they die with the assets in their estate, we do get the step up in basis, the income tax basis, to the point that I made earlier with the $100,000 and the $1 million example. Wisconsin is a unique state in that when one spouse dies, everything in a marital estate gets a step up. So it could be that the wife owns a very successful business in her sole name. It's still considered marital property, but it's in her sole name, and her husband dies first. Her business would get a full step up as a result of marital property. So we have an awful lot of clients where we advise them, don't do anything before the first death. Become more thoughtful about transferring business after the first death, because at the first death, all assets get a step up, and then we can really be more thoughtful about transferring it. Real quickly, these are statistics that they're meant to shock, to the point I have 75% of my mother and dad's children have no estate plan, so it's the same thing. Most business owners don't get to this. This is the point I'm trying to make. How we do this, real quickly, we have a process where we, in a pretty streamlined system, we come out to business owners and we take a snapshot of where we are today as a business. We then meet individually with current shareholders, current people who want to become shareholders, and we go through interview processes and we basically do a gap analysis. We say, hey, we're at point A, we want to be at point C. How do we get from A to C, and what steps do we need to put the company in a position to transfer? So that is really quickly, I mean, we spend upwards of an hour positioning that process for clients of ours, but it's quickly stated how we approach succession planning for business owners. So are there any questions on this topic? No, oh, there one is.
When you talk about selling to management, are you talking about an ESOP or outright selling?
Either or. The question was, when we talk about selling to management, is it a sales to an ESOP or sales to simply managers outright? And we do both. We've assisted, it's interesting because right now in our construction industry, we're seeing an awful lot of ESOP action. So we're assisting some very large construction companies making sales to ESOPs. Similarly, we have a couple of other construction companies who have a rolling succession plan. When a senior construction exec reaches retirement age, they pick out the 3 or 4 new superstars who are coming up and give them the right to buy in. Yes, one more.
So a sale to a grantor trust, of course, would be the loan between the grantor trust and the owner. You said there is no taxable event at that point?
That's right. So the question is, to the point that I made earlier about these tools in our toolbox that are quite sophisticated, one of them is what's called a sale to a grantor trust. And to the question is there is no tax implication to the sale to a grantor trust. It's a disregarded transaction, so it's complicated, but that's an easy answer that the sale is, you can sell your company to a trust, receive money back from the trust over time and not pay a capital gains. The basis doesn't get adjusted, so when you sell it, it's as if you gifted it. So ultimately, if the children sell it, they will have a capital gains because it's not a taxable transaction. Okay? All right. You want to close out, Peter?
Sure. I think we took all of our 2 hours, but hopefully you guys got some good information. We'll be here for a little bit yet if you've got any questions for us specifically. Otherwise, again, we certainly appreciate the opportunity and thanks for coming.